Good morning. Welcome to this update on Friday the 3rd of June. I'm Tom Colley and I'll be taking you through the news and the markets. First, just to mention, we are at the London Forex Expo today, all day. The Grange Tower Bridge Hotel. More details at londonforexexpo.co.uk. If you're in and around or you're coming anyway, please stop, have a chat with us. Let us show you in more detail exactly what we do, how we do it, and hopefully explain or find a way that we can help you move your trading further forward. Okay, over to the news, and it's a news dominated week, and we really got into the thick of the news yesterday. We had the OPEC oil meetings. This is the meeting of the oil producing states from the group called OPEC, which now only control about 40% of the world's oil production, having in previous decades controlled the vast majority. The result of or the intention for this meeting was to try and find create an agreement for a cap on oil production. That once again failed. The reason predominantly being was that Iran believe that they have the right to increase their production levels to pre-sanction levels. Sanctions were removed a few months ago before considering a cap. So nothing, no result out of that. Again, I'm not sure that very much was expected. Also on crude, we had the oil inventories out of the States. These came in below expectation. This means that the oil surplus or the oil supply stock holdings in the States are reducing at a slower speed than was forecast. The net result of both these factors is they should both produce downward pressure on the price of oil. We'll have a look at the oil chart shortly. The other big news event yesterday was the ECB minimum bid rate and press conference. Well, the headline rate remained unchanged at 0%. The deposit rate remained unchanged at minus 0.4%, so a negative figure on that. We then had the press conference with Mario Draghi. Not a great deal was said here other than we're waiting to see the effects of the last increase in the easing measures. So really a little bit of a non-event in that respect, so we didn't see a great deal of action out of that. Going forward today, we have the non-farm payrolls. Last month we came in considerably below targets. There were extenuating circumstances. There's a particular strike in the States at the moment, and strikers aren't counted as being in this employment change. However, this month we've got a considerably lower target than we've had previously. The target or the forecast for last month was around the 200 level. The forecast for this month is only 159. That could be seasonal and or a realization that increases in the levels that we've seen over the last 12 months just aren't sustainable long term as more and more of the population become employed. We'll also very much be looking out for the average hourly earnings. We've been watching this all year. Probably ahead of the simple non-farm figures, for the simple reason that employment is, or those numbers have been so strong. These figures really reflect the quality of those jobs and the earning potential of existing employees. Okay, so over to the charts and the markets themselves. Well, over in China, the Shanghai Composite, the composite of the major equities markets in China. We had a very bullish day on Tuesday, potentially intervention, can't say that for certain, but can't see another reason for it. Then price, in rather a quiet trading, has held at this 2925 level here. Over on the Nikkei, we're still much dominated by this triangle formation. We very nearly saw a breakout up here at the beginning of the week, but we're still within this triangle. We haven't, as Phoenix Blue, got a bias on this market until we break out long or short on the triangle. However, the only way of looking at this week is a bearish risk-off week. That's been reflected in this US dollar JPY exchange rate, where we're seeing the yen strengthening as money comes out of the Japanese equities and into the yen itself as a safe haven. This is a market that we're cautious with at the moment. We always anticipate Bank of Japan intervention. Officially, it won't be happening anymore, but I'm not a great believer that that's the case. They just won't announce what they're doing. We are cautious this market. We're really looking for something to buy potentially around this level here, or we'll be looking for a break above this level here. Should the things move in that direction, and should we get some more dollar strength based on NFP. Over on the dollar index itself, well, we've had a pullback this week around to the 95 zone. We're looking for a move next up to around 96 and onwards from there. The non-farm figures today have the potential to move that price up in that direction. Our bias still remains long and will continue to do so whilst we're above this channel. S&P 500. Well, interestingly, we've had a very much a bullish day yesterday. This is a market that seems to have changed slightly over the last few weeks. It had been responding to the increase in likelihood of a rate increase in the States by weakening, becoming bearish. But in recent weeks, as the news data and expectation of a rate increase in one of the next two Fed meetings has increased, equity markets in the States appear to have taken that simply as that the US economy is in a better state. Potentially because at the beginning of the year there was talk of 4 or 6 increases through the year, and the start of that might have been more concerning. So with now potentially, realistically, maybe only a couple at worst and maybe only the one, the market's still relatively bullish. So interesting to see what will be happening here. I'll remain somewhat on the fence now until we break this key level at around 2,080. But there is potential here now for the market actually to move long to new highs for the reasons that I've just mentioned. Okay, over to crude oil. Well, we had the news overnight on the OPEC meetings and the oil inventories from the States. So both those, as we said, should be a downward pressure on oil. We've reached $50, which is psychologically a very big level. We're currently above this trend line. We at Phoenix Blue are very much bearish crude oil. We will be looking now for a break of this trend line in a retest of potentially one of these two levels here, looking down towards targets of around 44, 42, something like that. Okay, here's a commodities trade that we're in at the moment. We actually traded cocoa on a COT extreme signal at the beginning of the year. At that time we had an entry above this consolidation here, stops below. We do have to use much bigger stops on commodities because the volatility is much greater. We now have, for a different reason, very much June seasonally the strongest month for cocoa prices. So again, we're interested in this market. We became interested in the market when we had this trend line stroke channel here. We're currently in the market. We had an entry around the 3,000 level. Prices moved away, come back, moved away. But if you look historically at the way this market moves, it will do that before moving, such as there, off in a straight line. We've got T1 targets at this previous high here, looking for potential T2s at this high over there. So although it's a big risk, it's still in the region of a 3% trade, but that tends to be the nature of commodities in that respect. One other that I want to show you that we're looking at is sugar. Now this combines two of the techniques that we use. This zone here marks where we've got a COT extreme signal. That COT extreme signal is actually for a movement short. That means that the commercial traders in the futures markets are at an extreme position where they would normally expect that they would now be pushing the market down. However, if we have a signal like that and it is broken, as it was yesterday, and broken quite substantially, that we consider that an ignored signal. And when a signal is ignored, our bias switches immediately from being short on the COT signal, COT extreme signal, to long in this instance. Now, this is supported in this instance because sugar again is seasonally very strong through June. So we were really, to be fair, we were more looking for this move than the short on the COP, because we wouldn't have had factors lining up, because we didn't have seasonality supporting the COP extreme signal there. So now we're long this market. We've got a clear channel here. We've got a level of resistance. We're looking now for a break and retest of that to take this market higher on that seasonal strength. So that's just shows you a way that we use two of the elements that we employ, and even one of the elements, when it fails, creates a signal in its own right, the failure being that signal. Okay, now what you've been looking at here is what we call our pure analysis, clean charts, as you can see, price action based, horizontal levels only. We buy and sell with the institutions. We have a fundamental bias. We've just talked about what we can glean from the commitment of traders analysis. The seasonal analysis, again, the reason that I showed you sugar there was we're combining both of those elements to create a reason to trade. We're then waiting for a technical to give us our entry. We use very small 40 pip stop losses on FX majors. Obviously on commodities, as we've just talked about, they need to be bigger, but the small stops we use on FX means that you can be more profitable with a smaller number of winners. Okay, so if you've got any questions, go to the website, phoenixblue.co.uk. Any specific questions, email us direct at info@phoenixblue.co.uk. Don't forget, we're at the Forex Expo in London today. Any chance of coming down, we'd love to talk to you. But with that, that brings the trading week to an end, and have a nice weekend, and we'll speak to you next week. Take care.